Greetings. This is Market Wisdom episode 48, done by Twigbe Ezoge for forex, stock, crypto, options, and all chart related trading. We have been doing this for close to 20 years now. You can contact us for training online or physically and for account management. We are sure to guarantee you over 100% return consistently. I don't simply look at the classical chart pattern, head and shoulder, triangle, and so on, as independent formation. Rather, I tend to look for certain combinations of patterns, or in other words, patterns within patterns. These more complex multiple pattern combinations can signal much higher probability trades. Most chart patterns are accurate 50% of the time, but that is not a drawback. A pattern that works 50% of the time can be quite profitable if you employ it with a good risk control plan. Many economists have tried to trade the commodity markets fundamentally and have usually ended up losing. The problem is that the market operates more on psychology than on fundamentals. There are circles in everything: the weather, ocean waves, and the markets. Their length vary greatly from market to market. The markets are ultimately based on human psychology, and by charting the market, you are merely converting human psychology into graphic representations. I believe that the human mind is more powerful than any computer in analyzing the implications of this price graph. In 3 years since he assumed active management control of the quantum funds from his mentor and idol, George Soros, Druckenmiller has realized an average annual return of over 38% on assets ranging between $2.0 billion and $3.5 billion. I focused my analysis on seeking to identify the factors that were strongly correlated to a stock price movement, as opposed to looking at all the fundamentals. Many analysts up to today still don't know this. The factors responsible for stock price movement very often is related to earnings. This is particularly true of the bank stocks. Chemical stocks, however, behave quite differently. In this industry, the key factor seems to be capacity. The ideal time to buy the chemical stock is after a lot of capacity has left the industry and there is a catalyst that you believe will trigger an increase in demand. Conversely, the ideal time to sell these stocks is when there are lots of announcements for new plants, not when the earnings turn down. The reason for this behavioral pattern is that expansion plans means that earnings will go down in 2 to 3 years, and the stock market tends to anticipate such development. You could be right on the market and still end up losing if you use excessive leverage. When you earn the right to be aggressive, you should be aggressive. I was managing 5 different hedge funds at the time, each using a different type of strategy. The funds were up roughly between 40% and 85% at the time. There is historical tendency for the stock market to accelerate on the downside whenever all upwards sloping parabolic curve has been broken. George Soros, in his book, The Alchemy of Finance, theorized that if a huge deficit were accompanied by an expansionary fiscal policy and tight monetary policy, the country's currency would actually rise. The way to build long-term return is through preservation of capital and home runs. That is, grind it out until you are up 30 or 40%. And then, if you have the convictions, go for your 10% year. If you can put together a few near 100% years and avoid down years, then you can achieve really outstanding long-term returns. This brings us to the end of episode 48 of Market Wisdom for Traders. Remember to subscribe, share, or call us for account management and training on 080 375 97085. Thank you.